All right, folks, thanks for joining today. I know a lot of you guys have been trading options. We were going back and forth before this started going, but I'm sure I can teach the savviest of traders even a thing or two. So please stay with us on this as we are talking about the cash secured puts. Now, this is a great strategy to implement into any portfolio as far as I'm concerned. If you are building a portfolio of stocks, you should seriously consider using cash secured puts because you're getting paid to take some risk. When you're looking to buy a stock, you're taking risk, all right? And if you're picking locations to buy that stock, why wouldn't you sell a cash secured put at that same strike level or at that same level? If you wanted to buy Apple at 100, why wouldn't you sell cash secured puts and collect that dollar or 50 cents, whatever you can get out of it? And in the meantime, if it comes down, you buy that stock at your level, or you just get paid like an extra dividend for not owning stock in a sense. So you're constantly lowering your overall cost basis on stocks you would even already own as well. All right, so cash secured puts. Let me get a couple things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me from mainstream media where I've talked about the economic data, geopolitical environment, how that comes in to impact markets. I do the same thing pretty much in these webinars where I'm talking about what I see going on in the markets, and then we talk about option strategies around those types of assumptions. But anyway, I started out trading in college, moved up to Chicago Board of Trade, and I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products. Anyway, cash secured put, we know we're talking about that, but a couple of things I do want to get out of the way. I know some of you guys out there said you trade a lot of options, but here's some things that options tell us anyway, and I'll give you guys some easy ways to remember how to remember what these Greeks tell us. And I hope you guys aren't all running away because we're talking about Greeks. But anyway, on the floor, we used to say delta is data. And specifically right now, I want to talk, though, how the options premium is going to be affected by the underlying move in that whatever option we're talking about. But delta will tell us a bunch of other things, probabilities of being in the money, probabilities of being, tested on our strike, all of those things that will help us keep our powder dry. But ultimately, for the beginner, we can talk about the options, and it doesn't matter if this is XYZ stock, an ETF, or whatever. Anyway, we're talking about these Greeks. Everything is an advancement. We don't move back when we're considering these options. So everything's an advancement. A dollar move higher, a day goes by, volatility adjusts, all of those things. And we'll talk about that here in a minute. But we're talking specifically about delta. And delta has a number coefficient correlated to the calls over here and the puts over here, all right? And we're talking about delta. So specifically on the calls, we could see down here if we picked these 150 calls and you draw a line straight across here. So we're talking about the delta here is 45. So on a dollar move higher to 149.35 in the stock, XYZ, $1 move higher, so increase of $1, right? We go down here to these delta, and the delta is 45 cents. So 45 cents goes into the options. We would see this move up to $4.05, right? And then $4.20. So that's on the first dollar move higher. Now notice on the put side though, the put side is all negative because of the advancement. So these puts would then lose the 38 cents correlated to its, on these 145s, it would lose 38 cents on that dollar move higher. Now think about it, if you move it down, a negative plus a negative makes that a positive. So if we started moving down, then obviously the deltas would add into those puts and these deltas would subtract out of our initial bid offer, all right? And then gamma simply goes with delta, all right? Gamma goes with delta, and this was dollar number one, right? Now we're talking about dollar number two. So gamma goes with delta on dollar number two. So literally it just changes delta on only that second dollar move. So gamma we have on the next line here. So now we're talking about gamma And we can see on this line, they are both positive on the calls and the puts. But on the calls, on the next dollar move higher, we're talking about 150.35. So we moved higher by now $2. So gamma goes with delta on that second dollar move. And now we would be talking about 48 cents going into our bid offer. All right. So then we'd be talking about $4.53, right? And then $4.68. So the second dollar move higher, and gamma going with delta on the second dollar move higher, our bid would then lose only 35 cents, okay? And then on the down move, second dollar move down, these would have increased by 3 cents because the negative down move plus the delta makes that positive, plus the gamma makes that 41 cents would have added into those puts on that second dollar move down. Does that make sense to everybody? Everybody pretty clear concept before I move on? Please jump in. If I'm moving a little fast, let me know because I will make sure you guys are clear. And theta is the thief. Theta is the thief in the night that comes and steals your premium every single night. He never stops. As a matter of fact, all he does is get more and more aggressive the closer and closer to expiration or these options going off of the market. The thief in the night gets really aggressive. So it's the impact of time. Theta, time, the thief, however you want to think about it. I like to think about it as the thief because further out in time, that thief isn't very aggressive. So closer in time, that thief starts getting more and more aggressive. Therefore, if you want the thief on your side, you would be selling premium. And if you want to limit that, if you were ever considering buying calls, it's more advantageous to go further out in time or puts further out in time. Yes, you are paying a little bit more, but that thief is never as aggressive. Plus, you can take care of or take advantage of a lot of other things that we've talked about in other webinars. I don't want to bludgeon that anymore, but you get my drift. We'll talk about that as we go along. I don't want to get too far ahead of myself. So theta on the calls and the puts is always negative because it's the advancement. Every day goes by. This thief is going to take some money from you. So if we were talking about these same 150 calls over here, tomorrow we would wake up and 6 cents would be gone out of our calls and out of our puts if we had those, no matter what. If nothing else changed, the underlying didn't change a penny. Just one day goes by, okay? And then finally we have volatility. And Vega is the most important Greek, and it's not even a Greek actually, but it is the most important Greek nonetheless, as far as I'm concerned, because it is what determines the options premiums, all right? Or it doesn't really determine it. Actually, buying and selling obviously determines it, but Vega is really what tells us if those premiums are expensive or are cheap. And it is what we need to really understand in order to gauge what those premiums are doing, because that is going to determine ultimately what kind of option strategy we would then get involved in. So anyway, Vega on this calls and the puts over here, really it's just implied volatility, all right? All right, folks, it's just implied volatility. Anytime you're really seeing volatility, Vega, all of those things, that's implied volatility. So that is Vega. And you can see Vega is positive on both the calls and the puts over here, in the puts on this side. And that's because the assumption is an increase. So if these increase by 1 percentage point, and folks, 1 percentage point increase in implied volatility of XYZ stock is not very much, all right? So it's increased just by 1 percentage point. That means our premiums will increase by that corresponding Vega. All right, pretty simple. So obviously it's assuming it moves up, but we will see that volatility moves very dramatically, almost more so than what we would even see in the underlying stock. All right. So what we have to determine is, where are we going? Okay, the idea here is when you're coming into the concept, I'm thinking about people looking at their portfolio, all right? And it's kind of like when you're planning a trip. Most people plan a trip and spend more time doing that than their financials, which is kind of funny. But nonetheless, we determine where we're going to go. So let's just say, for instance, everybody wants to buy Apple. And as far as I'm concerned, I've never been a huge believer in Apple. I've missed the boat on it, but I have traded around it nonetheless. I just don't own the stock necessarily. But I would absolutely be willing to buy the stock somewhere right around this area. That is where the most time and volume has been spent. That's where Apple is considered to be of value in the last 52 weeks. And the Apple car coming out and all of that good stuff, I am bullish in Apple. But the idea for me here is I want to sell some puts here. If it continues to move down, then I get my strike location. It would be kind of like, you know, if you said, I want to buy Apple at 110, right? So my idea here is why not sell a put right there, right? So I do have a bullish assumption, but I'm hoping for, you know, I'm hoping for a little bearish move here is the idea when you're doing this. And kind of like you would do, I would hope, if you've ever done something like dollar cost averaging on a stock or trying to think about a location where you would want to buy it. Do you just go out there and buy it in the open market? Or do you kind of play this game throughout the year and try and pick your stock location? All right. So the idea here, though, we need to figure out if we have a good destination. What I mean by that is when you're looking at planning a trip, you don't go somewhere in the middle of nowhere, right? You're trying to pick somewhere where there's a lot of eyeballs. There's a lot of open interest. There's a lot of things going on in and around what we are looking at. So when I'm talking about that with a stock, you know, let's say Apple, for instance, it's over $100 stock. So my rule here is a stock that is greater than, all right, folks, if it's greater than $100 stock, then we basically are just going to move like the decimal 3 ticks like that. So in this instance, 1, 2, 3, and that would be 12 cents, right? So the idea is then you look down here in the option montage, which is this page on anybody's platform where it has your options pricing and all of those things. I like to set it up a specific way, but anyway, 36 days to expiration. That's usually right around the wheelhouse that I like to look at. The closest to 35 days to expiration is what we used to call on the floor as the spot month. That's where the most people are trading. So that's where you're going to have the most open interest. That's where you're going to have the most eyeballs. So 12 cents to the bid offer on all of these stocks that are, strikes that are just slightly in the money or just out of the money, and make sure it fits within that. So it needs to be, you know, less than or equal to that amount, that number. All right. So if it's greater than $100, that, and if it's less than $100, folks, it's pretty simple. If it's less than $100 stock, then we want to say it's less than or equal to 10 cents. All right. So anything less than that, just make sure that the bid offer is less than 10 cents. You can see Apple's always going to probably be less than 10 cents, but with any other stock, that makes sure that you're not getting yourself into trouble when you're just going out there and trying to sell some puts. I don't want you guys to give up 25 cents to get into this and stuff like that, because 25 cents is $25 and that eats into your yield. So don't get into stocks where they're real difficult to get in and out of those options. All right, so the environment. When I'm talking about this, I talked about this. Volatility is the most important aspect of what we are looking at for options pricing, because it determines if it's low volatility, you know, it's kind of sunny skies, you can take your time, you want to get further out in time. That means you're thinking about buying it. You can take advantage of volatility. Oh, one thing I forgot to mention with volatility is volatility affects further duration options more than the nearer duration options most of the time. And so we want to take advantage of buying options with less theta decay and that opportunity, that volatility will expand for us, and then we would benefit from that. Now, low volatility environments, we want to be thinking about buying that. In high volatility, we want to be thinking about selling these options. Why? Because that volatility has expanded, and we can tell that those bands on implied volatility for any underlying will usually stay within a pretty good range. And we can define that when we're looking at a chart, basically. Let me get to a chart right for implied volatility. Now, this is something I would consider, we would say, all right, that's kind of out of the realm. This was during the height of the pandemic. We are kind of a new normal where volatility we've seen in the VIX. A lot of you guys are long-term traders and stuff like that. You can see, but we have a high and a low. So the VIX is very high. You know, the 20s are the new teens, as we are saying now, it seems like, in the VIX, which means we have elevated volatility, but we're not going to see this kind of volatility, I don't think, really anytime soon. So at the end of the day, we can define where a point in time is now in relation to where it's been in the past for implied volatility, all right? But with this strategy, because we're doing cash secured puts, we really don't care. We can benefit from that high volatility because it'll allow us to get further away from where the underlying is currently trading and get us really good strike location. But for me today, when I'm doing cash secured puts, I'm thinking I want to buy this stock. And if I get the opportunity to buy it at a great level, I'm thinking I want to buy it at certain levels, okay? And if you're a trader or things of that nature and you're thinking probabilities, you're probably thinking, you know, further down on the line here. But if you're thinking you want to add this to your portfolio, usually we would say, all right, we can spot it that it's pretty low. But if you want to really get down to the nitty gritty, you would say you're looking at the current implied volatility, all right, which is what we're looking at, implied volatility again. And we're going to take that sum and we're going to subtract it by the low volatility, because what we're trying to do here, folks, is get where we are within this range, all right, where the current is within the range, all right? And then we look at the high, implied volatility minus the low, right? So there is the range, all right? So we can look at 38. We could say that this is 38, right? Minus the high, which is somewhere around, let's just call it 68. I think that's what it was. I ballparked it earlier. And then the low, we could say that's, I think, 25 right there. So we could say the low is somewhere around 30, right? So we got I did that wrong. Sorry. This is the 30. Sorry. Got ahead of myself. And the high was 68. And the low is 30. Right. So we've got 8 over 38. Now I have to pull my calculator out, but that's basically somewhere around the 25 percentile, I believe, right? Somebody who's got a calculator faster than me. I'm on my calculator. Where's my calculator? My calculator's not popping up. Shoot. There it is. So 21%. So it's in the 21 percentile. Thanks, guys. All right. So what we would consider usually is that's pretty low implied volatility. And usually speaking, outside of trying to sell cash secured puts, if you're thinking about trading this as a trade, then you would want to only be doing this trade if you saw that the implied volatility was greater than 50%. I would say that is a green light if you're looking to do this as a trade. But we're looking for this as cash secured puts. So I'm going to try and stay mechanical with this in a portfolio where I'm going to continue to roll out in time these secured puts and collect that credit. And one of these times I'm going to get, put that stock, which is exactly what I wanted to do. I bought this stock at a level I'm secure with. And over that time that I didn't get it, I was able to lower that overall cost basis on it. or you could look at it like you got the dividend that you wouldn't have normally got. And why does implied volatility matter? Because when those premiums go up, they increase in value, right? When volatility goes up, those premiums go up and they increase in value. So we've got to be aware of that when we're trading. Is implied volatility in this trade? When I sell these cash secured puts, this underlying could go higher, all right, folks? And if volatility goes higher, you could see those premiums increase. And it's going to feel like, oh, I should be making money because the underlying is going higher. That's not always the case. So if you are newer to trading options and you want to implement this type of strategy into a portfolio where you've normally gone out there and just added stocks on any given occasion, and you want to try this, just know that if volatility starts increasing after you sold these puts, you could see them increase in value due to that volatility, all right? And you could also see the underlying coming closer to your puts and that put expire worthless at the end of the day, even though it's just trading right above it, you know, at a level that you were wanting to buy it. Now, if you really wanted to buy it and give up, do you want the penny or do you want the trade, is what we used to say on the floor. Do you want the penny or the trade? Are you going to wait for it? Just know that at the end of the day, when these options expire, they puts that are out of the money are going to expire worthless, all right? So if you really wanted it, let those puts expire worthless, and then the next day go out there and buy that underlying at the level you really wanted, all right? Is always what I would suggest there. Not trading advice. All right, so what's the duration? I like to take advantage of that theta decay, okay? So my idea is I want to continue to sell these puts over time, right? And collect, right? And every once in a while, I'm going to have that stock put to me. Now, then that's where I wanted to buy it. But over that other time, I was able to collect that time. So I want to get in and out of these puts rather quickly. So the bottom line is, you know, you want to beeline it. We want less than 35 days to expiration. Remember I said that was a real wheelhouse, that spot month. Less than 35 days to expiration, we will see theta decay really, really ramp up. We're going to see that theta decay work in our favor, all right? So we want to exploit it. Bottom line is, we're trying to get inside of this area. Why? Because we see a 50% drop in those premiums of the puts we've sold, okay? So we're going to see this really ramp up. Now, I like to get out of it, usually on a trade, folks, at 7 days to expiration, because I don't want that gamma and all of that stuff to to mess with my short puts. But if I'm doing this for cash secured puts, I want to ride it out to the end of the day, okay, and see what happens. Very last day, if the puts are in the money, you're going to be put that stock. Now, just know, I would suggest getting out of the puts, going into the open market and buying the stock almost immediately, all right? And then offset that trade that way, all right? You're going to lose money on the puts. You're going to buy the stock, but basically it will amount to where you were willing to buy that at your strike price, okay, folks? The reason why I would do that is because it's expensive to have that other transaction happen by a long shot. So it's just easier to get out of the stock, roll it, and go, okay? So, you know, if you're really new to it and you don't want to do it, it will cost you a little bit more. Just know that if you go into expiration, that will automatically happen to your in the money puts. All right, where do we want to go? All right, so how aggressive do we want to be? Also, we have to think about what spots do we want to visit, right? We want to think about, we're selling a put on this side. So a standard deviation curve looks like this. Now, I know there's a lot of guys out there that will talk about skew where the curve looks a little bit more like that, okay? I'm not gonna, you know, really debate that right now, but what I'm talking about, if you really want to get into this stock, okay, for instance, I was showing that chart of Apple where I was looking at those different price levels. That's just being more aggressive on the curve here. So, a half a standard deviation really is amounting to around a 36 delta is what we would call it on the floor. If you really add up all of the ones out there on the curve, a 1 standard deviation is right around what we would say a 16 delta. All right. This is really around a 36 to 34 delta. It's really a 34 delta, but we used to go for the 36 delta just to get a little bit on the inside of the curve. But I like the 36 delta personally, which is why I would call that. And all that is the probability of this happening is only a 16% probability of it happening. These puts we're going to be selling is only a 36% probability of happening. This is obviously less aggressive of a strategy. This is more aggressive. I want to kind of buy it. Like I want to be pretty aggressive with buying this. But I usually like to go in there and sell that 16 delta put. Over time, sooner or later, it will be moving in my direction. Yes, this is being recorded. You will access it. I think you're getting an email here relatively shortly once we kind of do all our magic, I guess. Not a whole lot of magic. Anyway, selling the puts, I usually like to go around the 16 delta. Now, in Apple, I'm really considering this 36 delta because it has already made that move. I think I can get a good, nice credit, get my strike location. I would add this to my portfolio. I'd add this to my IRA, all of those things. You can do this in an IRA. It's going to be a little bit more secure or more of a cash secured put in the sense where with an IRA, folks, you're going to have to, if you sell Apple at the 110 strike, you're going to have to put up the amount of money from 110 to 0. All right. It's like just buying it at 110 is how much they're going to make you put up for margin. You are going to collect a premium. All right. So if they expire worthless, you get to keep that premium, but the margin in an IRA is going to make you basically put up full boat. In a trading account or a regular portfolio, you're going to have to put up about 50% on this. All right. 50% of what the underlying value is. All right. Just like you would have to if you put in a bid to buy something, they're going to margin off an amount of money, hold that in case you get clipped on it. All right. So we're going to be looking at the cash secured put. All right. You guys got this, right? We've got the direction. We are bullish, right? We're bullish in this underlying. We definitely want it. We've got a good destination. The destination is the less than or equal to 10 cents, right? On the bid offer. Bid to the offer on a stock that's less than or equal to, $100. Right? Make sure if you're trading on the stock that's under $100 that it's less than or equal to 10 cents, right? Or you move the decimal 3 ticks to the left. On a cash secured put, the environment, we don't care. We don't care. We know we want to keep our eyes out for volatility, right? We want to look for vol. Vol's a good thing, right? We want volatility. Keep your eyes out for that. That's always an opportunity there for selling these cash secured puts. And then the duration. I like the less than, 35 days to expiration or as close to it as I can. All right. When it's inside of like 18 days to expiration, right? Then those further expiration ones that are like 45 days to expiration or something like that are the ones I would be looking at here. Strikes, I look for that 16 delta, on a more, mechanical basis. You got an overall portfolio. You're doing this over the course of a year. Look to do the 16 delta. If you found a move or something like that, or a price, maybe somebody told you, hey, if you could buy it at this, that's a great price. That would probably be right around the 36 delta is what I would assume. That's usually what people are talking about. All right. So our max profit is basically going to be that net premium received if you let this expire worthless. All right. You get to keep that credit. Your max loss, though, is that option strike minus the premium we're going to receive to that underlying going to 0. Is Apple going to go to 0? The short put strike, the short put strike minus the premium received is our break even. So think about it. If we sold a 100 strike, we collected $1 credit. My break even on this is 99. All right. That's lowering your overall cost basis. All right. Let's pull up an example of, Apple for that matter. Let me do this platform. Go to the trade, pull it over. So Apple, 36 days to expiration. So we're right in that sweet spot, folks. And what we're looking at here is the same page where we got the delta, the gamma, the theta, the vega. Now, if you want to be less aggressive, do this over time. You're just getting involved in this. Like this 110 strike would be the one I was looking at. It's as close to 16 as we can get. I don't want to deal with the selling those. When we're talking about good destination, there's not a lot of people trading those options unless they were in this for the long haul. So I would stay in here usually. But anyway, having said that, that would be as close to that 116 strike. And when you're looking at the charts on Apple, buying that at any one of these areas, I think is a good level to do that. So the 110 strike, that would be a nice credit. Now, keep in mind, for every one lot you're selling in options, that's equivalent to the 100 of the underlying. All right. So don't be doing 10 lots and stuff like that, because that's 1,000 of the underlying. Every one contract is equivalent to 100 of the underlying. So if I were to sell one of these 110 puts, folks, a one lot is equivalent to 100 of the underlying. That would mean my premiums would be equivalent to 138 if I was to sell this bid. $138 is what I will collect. All right. In an IRA, you're going to have to put up enough money to buy 100 Apple at $110. All right. You get to keep that $138 no matter what. All right. Even if that premium starts increasing and these puts go into the money, you have to think about it. I was wanting to buy it at 110 and I collected $1.38. So essentially you bought each contract at $108 and what is that? 62 cents. Doing it off the top of my head. Right? So you're really buying a little bit lower, but you get it at 110. So even if it's trading at 105 at expiration, you bought it at 110, resolve yourself that you wanted to buy it at 110. Okay? Does that make sense? So if I was wanting to sell this at 110, in a portfolio like this, it's going to be $138 is your max profit. You're going to have to, my margin's going to make it a little bit less, but most people on a cash secured put, you're going to have to put up half of what the underlying would be. So it'd be about $5,000. Okay. But if you guys are more interested, I know a lot of you guys were out there talking about that you guys trade a lot of options. Check out some of the other ones where we're talking about investment strategies that you can trade on any given day for a strategy where you're wanting to implement options as a trading collection of credit, collection of time, and how to get your margins set for that. Anyway, moving along. So we've got this, right? We're not going to get out of this. We're going to buy it. We're going to buy the stock if we get that opportunity. But with XYZ, we're looking at taking the 16 delta. If you're looking at implementing this over time, look for that 16 delta over time, or the 36 delta. Now, if you wanted to buy it today and go out there and sell those puts really aggressive, I have no problem getting really aggressive and going out there and selling like the 50 delta. I wouldn't necessarily go in the money, folks, on those. But right there, maybe at the 50 delta would be as far as I would go. But the 36 delta or the 16 delta if you're going for the long haul, all right? Just know your loss is equivalent to go out there buying it, if you put in an open order, folks, all right? If you went out and bought wanted to put something in there at the 100 level of Apple and the market crashed down, you bought it at 100. You know, never second guess that on a trade, right? That's all you can control is your entry, right? You can't control the markets. You can control your exits also, but with this, we want to buy it, as far as I'm concerned. Don't get out of it, on Apple anyway. So earnings with options. If you guys want to trade earnings, maybe some of you guys that were trading options a lot and want to know some great ways to stay mechanical around earnings, check this out. We have even done something on IBM. If you're watching the daily market commentaries, where trading options around IBM is fantastic and the earnings are great. Anyway, check us out. Go to this link. If you're watching this on tape delay, you're going to have to pause it and go. But here, I'm going to send this off to the entire audience over there in the chat window. You can click on that link to take advantage of this. But you guys, I have rules in and around trading options, and specifically around trading around earnings. You know, when you're looking online and or on TV, these guys on TV have a different agenda, to be quite honest. Even some of my friends who traded on the floor talk about the wrong strategies for earnings, as far as I'm concerned. So please check this out. And if you go through this and my thought process is off, let me know. Comment at the bottom. I'd love to hear from you. But take advantage of this, because all of these strategies, there's hours of content here and setting up. You might be thinking, hey, we're out of earnings already. No, this is even for setting up for the next earnings cycles and how to take advantage of that. Calendar rules are great. Thank you, Vance. Appreciate that. All right, so take advantage of that. The link is here if you're watching it on tape delay, but I flipped it over there in the chat window. It's going to bring you to a page similar to this for $36, you guys. If you're going out there and buying calls like some of these people are saying before earnings, I'm going to save you $36 in options. Think about that. That's only 36 cents with the option contract multiplier of 100. So that's pretty cheap, to be quite honest. All right. Thanks, guys. I appreciate all your time. Again, here is the link. If you want to reach out to us with any comments, questions, or future ideas, tradingandprotraderstrategies.com. Also, if you want to reach out to us at 310-598-6677, we'd love to hear from you. And finally, check out our disclaimer. This is not trading advice. Please consult your advisor about implementing this. But if you are trading, this is a good idea to implement around a portfolio if you're thinking about getting into options. One thing I didn't mention is this was one of the first strategies that I implemented into my options trading. When I was in college, I was trading, and I started selling covered calls against my stock, and then started selling some puts. Now, I did get run over back in the day in college. Those guys probably, well, they did. I was a one-lot guy, but anyway, I was giving up a lot of edge to get in and out of those with everything, but it was fun stuff. But that's how I got introduced to options. Selling puts to buy the stock, and IBM is a great one to think about implementing covered calls and or cash secured puts around, as far as I'm concerned. It hasn't gone anywhere in the last 30 years. Thanks, guys. Appreciate that. If you can't take that, take it easy.